Well, the Dow Jones Industrial Average down again yesterday. Material stocks selling off the most as the 10-year Treasury yield stabilized at around 3.2%. Flynn Zito Capital Management co-founder Doug Flynn joins us now to make sense of it all. Doug, good morning.
Good morning.
I'm curious what investors are most concerned about here, or is it simply that, hey, it's October, a pretty scary month for stocks?
Yes, October definitely has more 1% moves than any other month, but it actually also is positive more than people think. But the interest rates rising puts some pressure on the market in the short term. But if you look over the last 50 years, the 11 times that interest rates have risen, the stock market has risen 10 of those times. So in the short run, you might have a little volatility pickup, but in the long run, it doesn't bode the end of the bull market, at least where rates are right now.
But Doug, rates are going up, wages are going up, and material costs are going up. One reason why materials and industrials got hit really hard yesterday. Do you think we're going to start to hear warnings like that when we start to get third quarter earnings reports?
You can. In the short term, you definitely can. There's no question about it. I think you have to look a little bit beyond that and say that, while you have interest rate pickups and costs of borrowing, and that might put a short-term damper on things, it also rises the potential for increased revenue. And with 20% earnings growth this year, and it looks like maybe 10% earnings growth next year, the market has room to run. Things aren't going to get tighter until you get into the 4% range, at least from what we can see at this point.
Yeah, and the other issue that companies are battling, and consumers too, particularly with Hurricane Michael upon us, is oil prices and fuel prices going up.
Absolutely.
How do you expect the higher cost of energy to reverberate throughout the market?
Right. So, everyone has more money theoretically in their paychecks from the lower taxes. And so hopefully that's a cushion against some things like this. But all of these type of events are things that hit you in the short run, and eventually they smooth themselves out. All these major events are things that are just a regional thing in the short run. So I wouldn't worry too much about it having a long-term impact, because you have to look deeper into the fundamentals, and those still look very strong even with rising rates. We can support a little bit higher rates here.
It's interesting to me, oil prices are down 0.25% right now at 74 and change. I wouldn't expect that with the storm upon us and 40% of Gulf of Mexico production shut down, but that's the case.
Those are traders.
What do you make, finally, 30 seconds here, of the IMF warning yesterday, cutting their global growth forecast, including their forecast for the U.S. economy for this year as well as next?
I mean, it's not a surprise that after the types of earnings growth that we've had, that we would have a little bit less of earnings growth next year. It's hard to follow a 20% growth year with continuous 20% growth years. We're still the hot spot. We're still the place to be. Europe has not done well, although in September, actually the international markets outperformed the U.S. for the first time in a couple of months.
I'm going to give you another although. History shows, we'll see, because you're pretty positive, and I hear you, that the year after the midterm elections are good for your portfolio. So I don't know if the party might continue. Doug, thank you so much.
You bet.
Well,